In this presentation, I'm going to show how to use the effective rate of interest method here for amortizing a bond. And the example here will be for a bond issued at a premium. So I have the T accounts here for the assets and liabilities of the bond shown here on this side on the balance sheet. And then over here, I have the interest expense that we realize or recognize for that bond shown as part of net income on the income statement. So let's look at our example here. We issue a bond with a $100,000 face value and a 9% stated rate of interest. So we credit bonds payable for that $100,000 amount. Then we go over here and we actually receive cash of $104,100 for that bond. And that was based on discounting this bonds payable or this $100,000 principal amount or face value amount back using the market rate of interest here. So that was what its present value is. So we've got a make up a difference here. We got a $100,000 credit here with a $104,100 debit. So we do that through an valuation account here called a premium to bonds payable, and that increases the bonds payable amount here. So that would be the balance here between $100,000 and $104,100. So we credit this bonds payable for the $4,100 amount. So that makes our debits and credits equal here. We get $100,000 here plus the $4,100 here as a credit balance. That equals with the $104,100 debit balance. So what we're going to do here with this premium to this bonds payable, we're going to amortize it down to a zero balance. So when the bond matures, the carrying value will be equal to the bonds payable amount here of $100,000. We're also going to look at its interest payable here. Those are the payments that we make to the bondholders on that interest expense, and that's based on our stated rate of interest of 9%. And in this case, we have a 5-year bond. We have semi-annual payments, so we'd have 10 payments here, and we divide our 9% interest by 2 to get 4.5% per period, and there we take that 4.5% times the $100,000 face value to record here a payment of $4,500 semi-annual payments. Then over here we're going to go and record our interest expense here as part of the net income, and that is based on the market rate of interest times the bond's carrying value. Okay, using the effective rate of interest, we'll amortize this premium here in this bonds payable account. Now remember, this premium bonds payable account is a balancing account for our cash and our bonds payable, and it's also a balancing account between the interest payable and the interest expense. So here's how we calculate or amortize that premium. Okay, we have our start out here with our $4,500 interest payable to our bondholders each period, and then we subtract out the interest expense. Now that interest expense is based on the market rate of interest times the carrying value of the bond. So in this case, our bond had a carrying value at the beginning at $104,100, and then we had to figure out our market rate of interest for that period, which was 8%, and it would be divided by 2 for semi-annual payments. So we take 4% here times the carrying value, $104,000, we get $4,164. Then we subtract or determine the difference here between the payment that we're paying to the bondholders and that interest expense that we recognize. So the difference here would be $336 in this case, and that is the amortized amount of that premium. Now we take that amortized premium amount here and subtract that or reduce our carrying value on that bond. In this case, it would go down to $103,764. So we just continue the process here where we have our payment amount, then we determine our interest expense that we realize for the period. You subtract the two and you come up with this amortized premium amount. Then you subtract that from the carrying value or previous carrying value of the bond, you get the new carrying value. So after we amortize this premium down to a zero balance, it would be a $4,100 premium amount that we amortized. It would reduce our carrying value on the bond from $104,000 down to $100,000. Now just comparing here our interest rate that we paid to our bondholders of $45,000 total to the interest expense that we realized on that bond, $40,900. The difference here equals this amortized premium amount. All right, let's review what we have done here. We've taken this premium and bonds payable and amortized it down to a zero balance. And by doing that, we've taken our carrying value of the bond here from $104,100 down to its maturity value of $100,000 here when it's due. And that was reduced, that carrying value of the bond here was reduced by that premium amortization each period. Now let's look at our premium amortization here, how that affects the interest payable and the interest expense balance. So we had a $336 here premium amortization for the first period, and we have that would be a debit balance here, and then we can add it here to our interest expense balance here of $4,164. And adding those two together, we get a balance here in our interest payable account of $4,500. So that's the balancing effect here, where we take our debits to our premium on our bonds payable on that amortization amount here, and we add them in here with our debits to the interest expense that we realize each period. And those debit balance equals our credit balance here in the interest payable account. So there's our balancing effect. So what this bond premium account has done here in review, it balances this cash account and this bonds payable account, and it also balances the interest payable and the interest expense account. So at the end of each period here, we have to remember that we have to reduce this interest payable by the payment to the bondholders, interest payment to the bondholders, and then we reduce our cash or credit our cash for the reduction of that payment each period. And also when that bond becomes payable at the maturity date here, we reduce our bonds payable by $100,000 and also reduce our cash amount by that $100,000 amount.